Jay Powell. Yes, sir. Yes, Jay. I'm in the middle of a show. Welcome, everybody, to Markonomics 101 presents Hoot Loot, the place you go to be informed, be amused, but never be misled, like Jay Powell apparently is, as you saw at the beginning of the show. We're going to talk about inflation today. Today's show is called The Perfect Storm. That's why I'm sitting here about to be nailed by a wave behind me right there in the boat. And we're heading for something like that ourselves. And Jay, I think, is very confused, and we're going to have to set him straight. But in any event, please like and subscribe. We love you guys. We love all the new subscribers we're getting. And this show today is going to be phenomenal. The information is going to be phenomenal. Stuff you never knew, but you're going to know it. And it's going to be all the way through to the end. And it's going to be great. You're going to learn so much today. We love you. We'll be right back with the charts. Welcome back, everybody, to Hoot Loot. We're going to take a look at the charts. And first, we're going to start with a really 50,000 foot view level. This is Standard & Poor's 500 over 20 years. Notice that we have a bearish reverse wave, and you're going to get sick of hearing that. Reverse wave, reverse wave, reverse wave. What does that mean? It means that you have moves of higher and greater amplitude. In other words, you have lemmings chasing lemmings and then chasing them the other way and then the other way until you have like a series of higher highs and lower lows, which looks like a megaphone, but it's really an emotionally driven market or a Fed intervened market. That could be the reason we're seeing so much movement and so much volatility, because they love to interfere with markets, and when you interfere with markets you get volatility and you cause problems. So that's why I want to start with this, because this is showing you right now that we very well could be at the top of our lifetimes. That's why this is the perfect storm. It may not be that way, but this is likely to be a very major top, and we're about to see it almost any day now if we already haven't. So the next one is a volatility index. Volatility is a measure of daily disparity in prices. In other words, are we going up 1% a day? Are we going down 2% a day, et cetera, et cetera? Volatility is very important because it's a measure of fear. When it goes really high, that's a measure of fear. Now you see two spikes here on this chart to 85. One spike was the bottom of 2009. The other one was the bottom of 2020. They were exactly at 85. And if you look at it, if you actually compare this to the S&P, which we'll do subsequently, over 50 almost always calls a short-term bottom. So, you have to look at this thing occasionally. It's not the best timing indicator, but it sure did hit 2020's bottom perfectly. Going on to the Dow, ascending wedge. I know you're sick of hearing it, ascending wedge. But once again, we're in that kind of pattern, and that kind of pattern occurs when you are running out of gas. In other words, you are starting to, build slower momentum. There isn't enough buying pressure. And so invariably, these patterns tend to break down. The Dow pierced the bottom of the range and kind of rallied back into it today. I don't expect that that's going to continue, but we'll see. Now this is a Dow Jones Industrial Average using 2-hour intervals. So it's like a 3.5 month chart instead of 1 year chart. So we kind of zoomed in on the last 3.5 months. And look what we have, a reverse wave. What this shows again is even in the short term, we're seeing lemmings and we're seeing volatility and we're seeing emotional trading. This is emotional trading. What you're looking at here is emotional trading. It's people who are panicking at the bottom, they're buying out of greed at the top, and they're just chasing and chasing and chasing and losing and losing and losing and losing. So that's why I put that there, because it gives you a slightly different viewpoint than the 20-year look, which is 50,000 feet. This one is kind of through a microscope. The Nasdaq 100, really critical. This one broke down first. As you can see, it broke down from its ascending channel. And it really doesn't look good. It's making highs below highs, lows below lows. That's called a downtrend. That means it's very likely that this thing is not going to make higher highs at this point. Next support, 11,000. But even at 11,000, these stocks are so overvalued that they're still going to be overvalued at 11,000. I would say that any time you can get some liquidity and get the hell out, take it. You want to be liquid when there are opportunities. Okay, if you don't have money when there are opportunities, you can't take advantage of them. So now's the time to sell and to get liquid. Wait for a good setup. This is Nasdaq 100 2-hour intervals again. And the reason I did this is because you're seeing here another pattern that we talk about too much, rounded top. But a rounded top pattern is usually the kiss of death. We see it most of the time, not always, but this one has broken through the rounded top. So this one really does look like it is leading the market lower. The S&P 500, it also broke through its trend channel. It looks a lot like the, sort of a mixture of the Dow and the Nasdaq. And here's 2-hour intervals again on the S&P 500. Notice the rounded top. Okay, I know it's repetitive, but these are the patterns you need to look for. It's not that hard. There aren't that many. So if you can spot them and understand them, then you can start to act accordingly. Now, this is the small cap index, and this thing, reverse wave. Okay, once again, higher highs, lower lows. What does that mean? People are chasing stocks on the way up. They're panicking and selling on the way down. They're causing greater amplitude all the way along. It's a bearish pattern. It means dumb money is in the market like crazy, and that is the kiss of death. S&P 400 mid-cap index also broke down, kind of came back. These are probably the best performing asset class for a while. This one also looks like it's about had it. The Dow Jones Transportation still acting pretty well, actually, surprisingly. But it does have 2 7-point reverse waves, one within the other. So it's inevitable that this thing also will follow suit, I think. Now, we're going to talk about inflation for a little bit. Today, this is a Commodity Research Bureau, the CRB index of commodities, almost at a 5-year high. Today, this consumer price index was actually announced at 0.4. If you annualize 0.4, that's 5%. That's a lot higher than bonds are yielding. And not only that, but the market rallied on this news because if you took out food and energy, which no one uses, I don't use any food or energy, you had 0.1, which is perfect. Jay's happy about, oh, Jesus Christ. Yes, Jay. Yeah, you know that a 0.4 CPI annualized, that's 5%, right? You get that. And you get the fact that 10 years still at 1.5, all right? So I think that you're a little behind the curve, but we'll have to pick it up later, okay? And I can't make lunch next week. I've got a mani-pedi, okay? Talk to you later. Bye. Anyway, so the Commodity Research Bureau is the is probably the best basket, and that is showing inflation. And if we have inflation and we have yields that are so low, we're going to have a hell of an adjustment period. Crude oil is one of the reasons we do have a lot of inflation. It's a factor in just about everything. Almost everything has some petrochemicals in it, crude oil in it. It is so omnipresent in just about everything. So crude oil is a very good indicator that we're going to see this thing filter through the system, even though the CPI reported energy costs as going down in the month of February. And I think that's hilarious. Government statistics are hilarious. They never consistent, and a CPI of 6 today would be like a CPI of 12 yesterday. They change the algorithms all the time, and so you have to be very, very skeptical about government numbers. Look, observe, see rents go up, see gas prices go up, see food go up at the grocery store. McDonald's is raising its prices. That's called inflation. You can see it for yourself. You don't need a phony statistic to tell you it's not there. Unleaded gasoline continues to go higher. Apparently, people are driving again, this thing has just shot up. If you're in California, that 206 that it's gone up to, you're paying that in taxes. Okay, this is without tax unleaded gas. So yeah, the state and federal taxes probably double it at this point. Copper miners, again, another major source of building materials, still in a parabolic uptrend. this is inflation. Jay, this is inflation. I know you're a subscriber and you're going to be watching this. It's inflation. US dollar index is actually rallying. Now, this is a little bit of a contradiction because the dollar going down, devaluing, is inflation. Yet it has gone down for most of the time period here, but at the very recent period, it's formed a rounded bottom. Looks like it's heading up. I think it may be a factor that inflation in other countries is even worse than ours. So we could have relative inflation that doesn't look that bad. It's really hard to tell right now, but it will sort itself out. And I expect the dollar to resume going down. It has to. Basically, reports are that the money supply has almost doubled in the last year, which is unbelievable. How much stimulus do you need? You know, 3 cups of coffee ought to be enough. All right, so Treasury yields. Now, these are 5-year Treasury yields. Look at this. These are now almost at 1%. They were at like 20 basis points 6 months ago. So again, the percentage increase is huge when you go from 20 basis points to 80. That's like going from 80 basis points to, 4 times that, or 3.2. And we still have very low rates. 5-year historical average is probably about 4 or 5%. So we have a long way to go up. And if inflation is running at 4 or 5% now, which is underreported, you know where bond yields have to go to compensate investors, okay? And what's interesting too, we'll go on to the 10-year Treasury. Also, this thing has gone up. Now it's at 155, which is amazing. Now, I'm going to tell you, and our yields are higher than anybody else in the world. If you go to Germany, minus 0.22 for a 10-year Bund. If you go to Japan, you get 0.12 for a Japanese bond. If you go to the UK, you get 0.7 basis points. No, actually 71 basis points. Jolly good. And en français, negative 0.07. That's not good either. James Bond was a positive. That's a negative. Italy, 68 basis points. We yield the most. We're attracting money in. That's why the dollar's going up. Simple as that. They're going to have to raise their rates. And when they start unraveling negative rates, oh my God, I can only imagine what's going to happen. 30-year Treasury yields, these are still low. I mean, they're 2.5% or under. And, historically, average has been more like 6 or 7. And there's no reason they can't go to 10. And if you look at how much that has cost, here's an actual ETF which mimics inversely the 20-year Treasury, 20 plus years. It's lost 20% in capital gains. So you got your 0.5% in interest, that's good, but you lost 20% in capital gains. I thought bonds of the US government were supposed to be safe. They're not when they're yielding nothing. They're as risky as anything can possibly be. And I'm telling you, some institution out there is betting the wrong way, and we are going to have the beginnings of a crisis. I don't know when it's going to start, what institution it's going to be, but normally you leverage short and you buy long. And if you do that, you're going to lose money, okay? This is a great hedge, and I really like this. This is a ProShares ultra short 20 plus year treasuries. It's the opposite of what you just saw. So if you are in a situation where you're negatively impacted by interest rates, this is a great hedge. It's also a great thing to buy because interest rates are only at 2.5% or something, 2.4, and what if they go to 7? This thing could go way the hell up. So it's actually a pretty good speculation in addition to being a good hedge. The Grayscale Bitcoin Trust, Bitcoin, everybody loves Bitcoin, and I might be the only person that doesn't love Bitcoin. I don't love Bitcoin because everybody loves Bitcoin, and everybody thinks it has nowhere to go but up. I hear $1 million a coin, $1.5 million a coin, 100,000 a coin. Oh, maybe not. Okay, we'll see. But the thing is, what people don't even know what they're buying here. Okay, you're not buying anything when you own Bitcoin. You're buying computer code that you better remember, because if you forget your password or you lose it, you lost all your money. There's no way to get your money back if you lose your password. You cannot recapture it. People have lost hundreds of millions of dollars in lost passwords. Gold should be doing well. It's not. I don't know why. I think probably it has something to do with the fact that people are so in love with Bitcoin. But gold, honestly, ought to be going up, and it's not. It's in a terrible pattern. I've been bullish on it forever, so I feel like an idiot. But it's broken down, and you have to listen to the charts. The fundamentals tell me that there will be a bull market in precious metals. It's just not now. So you have to kind of bide your time, get liquid, and as these go down, they're going to be good buying opportunities, good setups. Just be patient. Silver too. The Reddit rebels, you couldn't do it. Silver's too big of a market for a bunch of Reddit readers to move, and that's all there is to it. They're not going to move a big market. Even the Fed has trouble moving markets. Okay, they control interest rates, but right now they don't. They don't control the 30-year rate. That's all market driven, and that's the Federal Reserve and how big they are, and they still can't move it. So if you're a Reddit person and you think you can move silver, good luck. You might as well send your money to me, because I can put it to better use. I can get Ace better dog food. All right, so now we're going to go to some of the high-tech stocks. These are important because they're worth a lot of money and they trade for enormous value. Apple was the first one to break down. We mentioned it about 2 weeks ago, said this does not look good. It broke its trend line. It was worth about $2.3 trillion at the time. And the point was, it's a poster child for the mania we're in. $2.3 trillion is greater than all but 7 countries' GDP. All but 7 countries' GDP. Apple is worth more than 7 countries' GDP. I know I said that 3 times, but honestly, that tells you what kind of mania we're looking at. Amazon, retailer, broken down. Again, we're seeing slowdown in the economy. All the retailers are starting to not look good. This is a very heavily weighted company, so it's very important in the grand scheme of things. Facebook looks okay to me. I'm not going to do any fact checking right now because I don't think we have time, and there aren't many facts to check other than the chart looks it looks okay. It looks okay. It doesn't look bearish yet, but it will follow the market down. One of the things that higher interest rates are going to do is they're going to squish the multiples, the PE multiples of high growth companies. So Facebook, instead of trading at 40 times earnings, will go to 20 or 25. It doesn't mean the company's bad. It just means it's competing with an asset that is generating more income. And so people gravitate toward that asset and away from the asset that generates less. Simple as that. Google is looking real good. It's in, again, an island top. And the reason an island top is important is that should it gap, all those people that bought in that box that you see are trapped at a loss. And so this island is not Tahiti. It is not Fiji. It is more like Alcatraz. All right. But other than that, it's a great pattern. And again, Google is at risk, not necessarily business-wise, but it's at risk of its multiple being squished. Because if rates go to 5% on the long end, I guarantee you this thing's going to be cut close to in half. Microsoft, same thing. Look, pattern looks good. It's a great company. I have no problem with it. It's made a little rounded top, possibly at the very end here. These companies are breaking down because of their competition with interest rates. NVIDIA is one of the high-flying chip companies. It's a gamer favorite. It also, it's one of the high flyers. It's broken down. Semiconductors are a huge portion of the Nasdaq 100. Chips supposedly are in short supply, although I don't know why people say that. I have as many chips as I need, and I can get them all day long. But NVIDIA has now broken down, and this is definitely a high flyer. So you got to be careful about that one. And the next one, Qualcomm, also chip maker, 5G, broken down out of a rounded top. I know you're sick of hearing rounded top, rounded top, rounded top, but you know what? If it makes you money, don't get sick of it. Embrace it. Tesla. I love to talk about Tesla, and I'll tell you, Tesla has a very valuable purpose in this whole presentation. It is the leading edge of the most speculative money there is. In other words, the people that buy Tesla are the ones that are the most optimistic, the most overly optimistic people out there. And I don't want to say dumb money because that's not really right. I've been dumb money before, but Tesla is breaking down. It's already gone down 30% from its highs. And no one noticed. No one noticed. At its highs, we pointed out that Tesla was worth more than all but 15 countries' GDPs. And this is a company that sells 500,000 cars a year. Okay, so that ought to tell you something. This has a long way to go down, potentially, but I would not short it. The reason I would not short it is because it has a high short interest. A lot of people short it. It's a very tempting thing to short, but as you've seen, shorting can be very dangerous. Now, the banks, these guys are basically still chugging along like everything's perfect. I think the theory behind it is that, banks borrow at the short end basically for free, and they lend at the long end. So they get, as rates go up, they get a higher spread. The problem is, as rates go up, they devalue all the assets on the balance sheet. So anything that you own that's a financial asset is devalued by higher interest rates. Simple as that. And so, it's not a matter of something bad happening. It's just the competition between asset classes. And we've had bonds too low for so long that's props up stocks so long. And bonds have basically been rallying since 1982 when they were close to 20%. So we have potentially a long way to go the other way, and it's not going to be fun. It's not going to be pleasant. That's why this is the perfect storm. The broker dealer index, again, they're counting on a bunch of IPOs. We'll see. I think this kind of market can dry up in a hurry. There was actually, believe it or not, this one slayed me. Frontier Airlines, which has gone bankrupt twice, it filed for an IPO. Okay, it lost $225 million last year on $1.2 billion in revenues, and it filed for an IPO. And people are going to buy it. And broker dealers are going to sell it. I wouldn't, because that would be being misled. When we do not mislead. So the Dow Jones REIT index, this is an indicator of real estate. Where's real estate going to go? Well, higher interest rates mean harder to finance. That's bad. But inflation means it's a hard asset, and therefore it appreciates with the dollar depreciating. So I'm going to say that real estate will probably do pretty well in the long run, but it may have some pressure as rates go sky high in a hurry. Big oil, Goldman Sachs, a bunch of companies have said, go ahead and buy big oil because it's, again, a hard asset. I'm not sure I would personally because of the shale oil factor. And, that can come on stream really fast. And, conservation takes so much of demand for oil away. So that happens every year. And I don't know that this thing can go much higher, but we'll see. Biotechnology, interestingly enough, even though we have so many vaccines that I don't even know which vaccine is which. I don't even know what a doctor would prescribe for you to get a vaccine. And who's liable if you get the wrong vaccine, because people have died from each of them. Not necessarily many, but what if your doctor says take vaccine A and you take it and you die from it? Who's liable? That's my question. Gold and silver miners, these are doing exactly what gold and silver are doing, which is crappy. They all look terrible. They should be doing well. They're not, but these will be the best buys at some point in time. So just be patient. We're going to monitor them. We'll tell you when the right time is. Semiconductor index, this thing is flying away. I don't even want to look at it because these things just race to the moon. But with NVIDIA and Qualcomm coming down, I don't think they can go up too much longer. American Express, parabolic credit card company. Who would have thunk it? It just amazes me. Apache Oil, this is another shale company. And look at Apache Oil, it's just going gangbusters. The economics of shale become very good at about $60. So they start making money in a hurry, and then when it goes like below 45, they start losing it in a hurry. So, they shut the wells down and they bring them back on. Bank of America, who would have thunk it? A parabolic bank. Oh well. I, again, can't explain it other than the fact that people do not understand that higher interest rates mean all the assets on their balance sheet are worth less money. Costco, big retailer, look at that. This thing is just cratering. That is not a good sign for the economy. It basically tells me that right now the consumer's tapped out and that you can stimulate till blue in the face, it's not going to do any good, because at some point, just sending people paper doesn't really make them richer. You get rich by producing goods, not by printing paper. And that's what the stimulus is. It's printing paper. Doesn't make me richer. Doesn't make you richer. It makes you think you're richer. It doesn't make me even think I'm richer. So FedEx, another very important company because it transports so many goods. It is broken down from around the top, but it's kind of hanging in there. And so it hasn't quite really cratered yet. I expect that it will, because it should do what the retailers are doing, because it is delivering goods like Amazon. Goldman Sachs, the company that is just mind-boggling to me, still in a major uptrend, and this again from IPOs. And Renaissance IPO ETF, well, this one is actually broken down from around the top, and a lot of those goofy IPOs that came out early this year that made no sense, like DoorDash and Beyond and all those, that absolutely did not make economic sense, all of them are starting to go down. This is the kind of ETF that would hold them, and they were just trading on parabolic hope. That's all there is to it. DoorDash is my favorite because it has nothing other than people that shuttle food from point A to point B. That's worth $90 billion in my book any day. Home Depot, again, a big retailer breaking down. This is not a good sign for the economy. This is my favorite, Jets. This is the one that holds all the airlines, and they're all basically bankrupt, okay? Yet they're going up. I don't get it. I don't understand it. I don't think that airline travel will get to where it was 2 years ago for a while. It's going to take a while. It may never get there. So I don't understand why these companies are worth more now than they were in normal times. But buy Frontier Airlines. Make sure you don't miss out on that great IPO. Johnson & Johnson, consumer products company. They make Depends. Thank God. I know I can depend on my Depends. But again, this one's about to break down through critical support, and it's a Dow component. These are not good. See, you put all these together, they start looking really bad as a group, and that's why I'm showing it to you that way. Nike is huge, a Dow component also, and it's a consumer products company, probably much bigger than you think. It's bigger than I thought. When I looked at its financials, it's a Dow component. That means it's pretty damn big, and it's also broken down from around the top. I know you're sick of hearing me say that, but unfortunately, I have to. Target, also broken down. It was doing very, very well, and this is another retailer. There's no retailer right now that is doing well. UPS, in around the top. It looks like it, bounced a little bit, but I still expect it to break down too, because if the retailers are going to break down, this is going to break down. Walmart shoppers are completely tapped out apparently, and this is also broken down, another Dow component, and it's just, again, a bad sign for the economy. And then ExxonMobil, biggest oil company there is, and Warren Buffett just bought it. It's about to merge with talk with Chevron to become some major Standard Oil redux. Anyway, it's going up. It may have a decent dividend, but again, I would be very concerned about shale oil and the competition from that point forward. And then finally, I have to point out GameStop again. Guys, if you want to give your money away, please send it to me. Please send it to me, okay? You're giving this money away to the very people you dislike, and yet you're still buying this thing, hoping that somehow you're punishing somebody, I think. Well, you're not. You're doing them a favor by letting them get the hell out of a bad company. And I don't know what else to say about it. So with that, what I do want to say is thanks for tuning in. Please like and subscribe. We love you to death. If you have any questions, please email us, call us, whatever you want. We will answer all your questions, and we'll see you next time. Hoot Loot, Markonomics 101. See you next time.